You know that strange feeling when someone does everything right, but still gets punished for it? Yeah, life's not always fair. And in the world of finance, that kind of story happens more than you'd think. So today I want to tell you about a company that actually did a great job this past quarter. They delivered solid profits, improved their numbers, and even gave out some sweet dividends to investors. But guess what happened next? Their stock dropped. Hard. Crazy, right? Let's break this down slowly, cause this story's got layers. First off, the company's in the real estate finance game. Not the sexiest industry, I know, but they're a smart player. Instead of going all in on risky stuff, they keep a well-balanced portfolio, low debt, and invest in sectors like multifamily housing and life sciences. Sounds like a solid plan, right? Now, check this out. Last year around this time, they were making about 40 cents per share. This year, that jumped up to 54 cents per share. A huge leap. Most of that boost came from higher interest income and cutting back on interest expenses. Translation? They made more money from their investments, while paying less on their own debts. That's textbook smart management. And here's the kicker. Analysts weren't even expecting this strong of a performance. They predicted the company would earn 43 cents per share. But the real number? 46 cents. Boom. Beat the estimate by almost 7%. That should have been the moment the stock shot up, right? Wrong. Instead, the stock price dropped by nearly 4%. It's now flirting with its 52-week low. Yeah, investors were like, cool results, but we're not buying it. So what gives? Well, the broader market hasn't exactly been sunshine and rainbows lately. Plus, their two key sectors, multifamily housing and life sciences, are facing headwinds. The housing sector's growth is slowing, and the life sciences space, it's got funding uncertainties, especially from government sources like the NIH. Even with all that, this company's keeping it cool. They're projecting next quarter earnings to land between 37 and 47 cents per share. And they're expecting solid cash flow too, around 45 to 55 cents per share. In short, they're cautiously optimistic. And internally, they're confident. One of their top investment officers said their portfolio has one of the strongest credit profiles in the industry. Meanwhile, their CFO mentioned they've got some really solid assets, with a good mix of fixed and floating rate investments. Now, analysts weren't going to let them off easy. They brought up everything: credit trends, specific leasing challenges in life sciences, and even asked about future bets, like senior housing. Translation: Wall Street's paying very close attention. So what's the takeaway here? Sometimes in the stock market, even a strong quarter doesn't guarantee applause. Investors might be spooked by the macro environment, or just waiting for more clarity. Or maybe they're just being impatient. But make no mistake, this company didn't stumble. They hit their marks. They even handed out a 50-cent dividend per share. They're grinding through the noise like pros. And if you stuck around this long wondering, wait, who is this mystery stock? Well, here it is. NexPoint Real Estate Finance, ticker symbol NREF. Yep, they outperformed expectations. But Wall Street still shrugged. So now the real question is, do you follow the market's reaction? Or do you trust the numbers?